Mike Botkin and Adrian Pinto. Thank you both for coming back on Acquiring Minds.
Yeah, thanks for having us.
Am I officially the most frequent guest?
As I was just about to say, you're both practically regulars at this point. Mike, your fourth time. This will be your fourth time. Adrian, when this airs, it'll be your third time. You are both on today to share some exciting news. One Outdoor, your landscaping, Mike, is acquiring Georgiascapes, your landscaping, Adrian. So we have one Acquiring Minds guest acquiring another. The world is feeling very small, but naturally I love this. So we're going to hear this story and unpack it a little bit. Mike, to you first, please. Can you give us the top line announcement here?
Yeah, so we originally set up Benchmark Landscaping as the Florida platform, and getting to know Adrian and elevating our thesis, I should say, with what we're doing in the space. We are getting into a new market, Georgia, and Adrian is our lead platform in Georgia and is going to be running the Georgia market. So we have created One Outdoor Holdings, which would be our holding company for this, and partnering with Adrian at Georgiascapes.
Excellent. Adrian, you want to add anything to that, or does that get us there?
No, I think that's a good summary.
Great. Okay, so Adrian, you and I spoke, I think it was last week, maybe the week before. So in that interview, which has not yet aired, will be airing imminently. And what people will learn on that interview with you is basically an update to your first interview on Acquiring Minds and what you've done with Georgiascapes since your acquisition. And the short version is you've almost doubled revenue, not quite EBITDA, because you're reinvesting a lot of that profit into the business proactively. But in our conversation, we talked about it was mostly the positive aspects of your experience so far. I was going to wait for the more challenging topics for this interview, and so here we are. So people will already be familiar with a lot of what you've done with Georgiascapes from that interview, Adrian. But now let's get into some of the things that have been quite difficult. Please go ahead.
Yeah, I mean, I think we may have touched on this a little bit, but I think, one of the things that we have wrestled with nearly since the beginning, and certainly has been a theme that I've talked to Mike about for, over a year now, has been around some of the financing challenges that small businesses face when utilizing SBA lending. So in particular, the first thing that happened with us was we did not have a line of credit. The SBA lender that we utilized did not offer that. So we had to kind of pick a set amount of money to add to the balance sheet. And, the process for doing that was based off of the historical financials of the business. So we kind of looked at, based off of how the volume of the business had in the past, what did we think we kind of needed to float us, through as we were starting off. And quickly what we realized is we were growing way faster than the business had ever grown in the past. And therefore that amount of money was hardly sufficient. And, the first 6 weeks we were able to scrape by despite it being super stressful, but we've only kind of continued to accelerate that growth. And, the lack of line of credit has been an issue essentially the entire time. And then you couple that with some of the equipment financing needs. So, the landscaping space, it's not super capital intensive, but it's not not capital intensive, right? So every time you start a new crew, even if it's a maintenance crew, you still need a truck, a mower or two, some hand tools. Maybe you're looking at, let's say, $60,000 to $70,000 worth of stuff. And again, in a business in our position, we had just taken on this big SBA loan, and so I'm basically having to go to dealerships and saying, hey, we need to buy a truck. Should be literally the least controversial purchase there is. And, we're being faced with huge interest rates and all of this stuff, all because we had done an asset sale and created this new entity that had limited credit history. And so, basically, that whole first kind of year as we were growing a lot, instead of being able to spend a lot of my time on, things that frankly would be more beneficial for the business, I was having to spend my time on figuring out how are we going to, finance the next crew, and how are we going to, finance working capital that, on good projects that we were given. And so it was just challenges that I would say were both frustrating and not where I necessarily wanted to spend my time and brain power. And pretty early on in some of those discussions with Mike, as I was outlining, these challenges, I mean, he had kind of thrown out this concept of us kind of working together, because that's one of the things that they don't have to worry about, right? Having the financial partners that they do enables them to kind of focus on growth unencumbered by all of this other stuff. And, that was always interesting and appealing to me, but only became ever more so as we kind of kept growing and kept dealing with some of these headaches.
And Adrian, it's interesting that this hasn't come up yet with my other guests, although maybe it's just because I typically just have on the guests for the first part, shortly after they've acquired, not after they've been in it for a while. But do you assume that this is something that other searchers who buy medium capex to high capex businesses encounter for the very same reason that the business entity that's out there trying to finance whatever it might be is too young to get good financing terms?
I would say yes. I mean, I personally don't see how it isn't. I have talked to and thrown out on Twitter and different things like that. I've talked to people that have gone about this in other industries, and I'd say a lot of people have kind of thrown out ideas on how to get lines of credit that they were able to utilize. Some people have talked about equipment financing lines. But again, the irony is that we tried pretty much all of those resources. I mean, I probably spoke to 30 banks, including our business bank. I would talk to them all the time. They would see, all the positive cash flow coming in. I had personal banking relationships with them and was willing to personally guarantee lines of credit, and they still just weren't willing to, because they had these kind of hard and fast guidelines around how long of credit history an entity needed to have before they were willing to kind of play ball. And we, didn't have that credit history at the time. The business didn't. And so, yeah, I mean, I think it's the combination of, obviously utilizing SBA, having done an asset sale with this new entity and lack of credit history, and then being in a medium capex industry. I think those things together, if someone else was faced with that, I don't know how they wouldn't have similar challenges.
And Adrian, knowing what you now know, could you have negotiated harder or gotten a line of credit at closing? Do you think?
Not with my lender. It would not have been possible. And there was a lot of beneficial things of working with a lender I did, so I don't want to completely disparage them. And they were good to work with, and they were fast, and there was a lot of benefits, but I don't think I appreciated enough the challenges of getting that line of credit post-close. I mean, basically from what I've gathered from speaking with both some of the large banks, some of the regional players in Georgia, I mean, the prevailing sentiment is if you don't get that line of credit as part of your SBA package, your ability to get it afterwards is essentially zero for a year or two or three in some instances until you develop, significant credit history.
If I can jump in a little bit, I think what Adrian experienced is 100% the normal experience. We experienced it on our first two acquisitions, really. And luckily, just because of kind of our setup, we were able to get through it. But we had vendors that we would spend, anywhere from $1,000 to $10,000 a month with, asking me for personal guarantees. And as well as vendors that we would spend $50,000 to $100,000 with a month, asking for personal guarantees. And so if you think about an SBA searcher, such as Adrian, so he just personally guaranteed an SBA loan, he takes over a business, and then, he's already on the hook personally for that. And then he immediately post-close has to start putting more personal guarantees on. It's definitely a challenge. And I haven't met a newly acquired business owner that has not faced those challenges, and there's a variety of ways to get around it and to fight through it, and Adrian definitely did, but it's a massive challenge.
I guess this is the one reason why, as a buyer, you might want to do a stock as a first time searcher, acquisition entrepreneur, but do a stock sale. It probably isn't, given all of the other cons of doing that, you probably don't want to do it, but if you were to buy the entity outright, the stock sale, then you wouldn't have this issue, I guess, because it's all around the age of the entity, right?
Well, you're right, but I think the problem with that is the unknown. And you got to think like some of these businesses we're buying, and even the one Adrian bought, and I've never met the original owner from Georgia Scape, so I'm not speaking directly about him, but some of these businesses have been around for 10, 15, 20, 30 plus years, and you don't know what's, behind some closed doors, right? Everyone has some cobwebs. And so the risk with stock is the unknown versus asset, you're starting from a clean slate. There's definitely massive benefits to doing stock. But I'll give you an example. Like the last acquisition we did, the third day we were there, we're literally sitting in the conference room with the owners, and they got served papers for a car accident like 4 years ago. And luckily we did assets. So I was like, hey man, that's unfortunate. But if it was stock, like it would have been me signing the paper that I got served.
Yeah.
I mean, to me, what it highlights is that there are not enough financing products in place to really support, the acquisition of these new businesses post close, right? Like everyone talks about the SBA, it's great. I would consider it kind of a double-edged sword, but no one is looking at like, hey, what percent of employees are the same? What percent of customers are the same? What was the revenue like over the past? Okay, this is essentially the same business, even if it's under a different entity. We can, put in place some financing product to support that. And no one's really willing to have that discussion, right? Like I said, they have these guidelines, and it's like, if you don't check all of the boxes, you're, kind of nixed. And so I think to me that's what's really frustrating is because, like I said, we were doing terrifically, we were growing with the same team, all of these positive attributes that to me, logically, support some form of financing. And no one was really willing to have that discussion.
Yeah. Because the line of credit that they typically will offer that you can get at closing is based on historical performance, right? So kind of tied to the net working capital requirements of the business to date. But when you're in and that seems to be something that's generally occurs or is available. But when you're growing fast like you, Adrian, then it's a little bit of growth capital. I mean, it's a debt product, but it's basically kind of growth capital. And maybe that's the difference, the difference that they see, or they're different levels of comfort with either extending credit or not.
Yeah, I'm not sure the specifics and from an underwriting perspective of like why they can, why they're allowed to do one and not the other necessarily. Because even if they, even just a traditional line of credit that would have been in place at close, that would have still been, incredibly beneficial to us. Even if it was that smaller kind of just standard working capital size line. I think again, like my lender didn't offer that. And so it just wasn't something that I could have gotten anyway. Had that been in place, I think it would have certainly been helpful. But yeah, in terms of growth capital, yeah, certainly no one was, those types of lines, people weren't, was not accessible to us.
I don't know if I've ever even asked you this, Adrian. Was that a thought process of yours when you were getting your SBA about, working capital, or what happens if we do need a new crew immediately? Because I don't really think of that.
I mean, not really, because, well, first of all, I think for me, speed and certainty of close were like the highest, criteria that I looked at, right? And based on the three-ish lenders, or four, I guess it was three lenders that I had been in discussions with, the one that we ultimately went with, I felt like had those, were kind of the highest ranked in those two criteria. The other thing is, when you look at, and I have done this, if I look back at my own kind of underwriting model, in a good case scenario, I thought we would grow like 10% per year. And so, the whole working capital needs were manageable. That just didn't happen. We grew so much quicker that I never would have anticipated, I guess, the need that we ended up actually having.
Well, just Adrian, where do you think you would have grown to if working capital hadn't been this kind of artificial throttle on your business, or this credit?
Yeah, it's a good question. I don't think it would have been a much different situation than we are in today, but there's definitely been periods of time where, for instance, like today we started a whole new crew. There have been times in the past where that has occurred, and, you go through the headache of get it, like I said, the truck, all of that's, the hiring, everything. And, I'd say inherently you're kind of like immediately demotivated to just go do that again. because of what you just went through. For instance, like the last crew that we had added before this, I personally bought the truck in full and gave the business a shareholder loan for the truck, because I was like, the interest rates that we're getting offered are so terrible from dealerships. We don't have access to equipment financing lines. Like this, this is crazy. So I was like, I'll just do it. But when you go through that, obviously, then I didn't want to have to do it 2 weeks later just because we got a whole nother crew. So there's kind of this like back in the back of your mind, I'd say that you kind of lose a little motivation to go reach out to new prospective customers and go through, start this process all over again. And so maybe, if that didn't have to occur, I think it's possible that we would have grown a little faster. But I think a lot of the growth that we've gotten, I don't know that has been large, hasn't been that impacted by these challenges.
If I could jump in, because I think that's actually really crucial. So like one of the things that is a benefit of us, right? And meeting and getting to know and partnering with someone like Adrian is he's immensely talented and has proven that over such a short period of time of owning Georgia Escapes. Think about, and I'm assuming you can kind of hear it in his voice, and he's giving 10% of what he's really dealt with, is that think about how much time and energy he spent on securing those kind of things for growth. And for us, if we can come in and take those things away from his plate and say, don't worry about these, we will stopgap this, we will cover this, we will assist you, we will provide those resources. You do what you do, and you continue to grow the business, and you be a good steward of the business. So I think a question, Adrian, I would ask you is like, if you look back at your short period of time, if you wouldn't have had those same capital needs and even the time and energy that you spent on that, or in the back of your mind concern of that, do you think that would have helped you either cultivate a better staff or grow your properties or work on other things like margins or employ, like anything else in the business that is productive and forward moving versus calling 75 banks to get a loan for a car that is like crazy you couldn't get? So I guess that would be how I would phrase to you, Adrian, is what do you think of what in retrospect kind of transpired?
Yeah, 100%. I mean, there's been a lot of brain power spent on, financing of equipment, really trying to work on working capital and make sure that like, hey, we have this project, like, are we going to be able to, is the cash flow going to work because we have nothing backstopping us here? And, is the timing of everything going to work? There's been a lot of effort, stress at times, put forth on those, those things. I think that there's probably been some decisions that we've had to make that weren't necessarily in the best interest of the business, but because of these challenges that we're describing. So, as an example, I'm generally of the mindset that like, if someone comes to you with a good reason to buy a moderately priced piece of equipment, like you should do it, especially if if it's going to increase productivity, if it's going to help on your hours, if it's, all those things are obviously profit, driving. And so, but there have been times where we haven't been able to say yes, and I've had to kind of say, well, maybe not this, this month, like, let's see how things shake out. Like, and those are things that I would prefer not to have to say, right? Because they're not, again, necessarily in the best interest of the business. And so I think, you couple those types of decisions with, like I said, some of the brain power and stress and whatnot that's been spent on these things, which are also not, value maximizing. And, the idea of being able to take a lot of that away and just allow our team to focus on what, we've proven to be pretty good at, which is, onboarding new customers and growing and quality and all of that stuff. Like, to me, that's a huge win. And certainly something that's personally appealing. And so, that I think as Mike and I had discussions, and that was kind of, a big topic of the conversation, that kind of, I would say, drove me to, want to kind of continue and further those discussions because of, having to deal with that in the back of my mind.
Well, let's start easing into the story itself here about how this unfolded. But first, a little more context from you, Mike, on your end. So I know your company is Benchmark, but as you just said, you have kind of started a new entity above Benchmark called One Outdoor. So let's hear about kind of how big your business is today. Give us a snapshot of what Benchmark, One Outdoor looks like today, so we have context from your side.
Yeah, absolutely. So this is our sixth acquisition. And when we originally started out, it was buying landscaping businesses, the greater Orlando area. And then we quickly saw the opportunity and stretched that to, the Central Florida region and then the Florida area. And as we've gone about buying more and more businesses and seeing the opportunities, and each acquisition we do is bigger than the last, we've seen that it's really not about the actual landscaping business. It's about the person that's running it, or the people, or the team, and the customer base. And just like a funny side note, it's actually not funny, but interesting side note is the first few acquisitions we did not have any of the owners stay on. I was the de facto owner operator of those businesses, largely because I felt like A, it was needed, but B, I needed to learn the industry. If I was going to be able to sit down at a lunch or breakfast or dinner or whatever with a landscaping owner, I need to understand and have sympathy and empathy and just general understanding of what they go through on a day-to-day basis. And I think that's helped me a ton. But where we've transformed in the past couple acquisitions is to be the owners need to stay on and have vested interest and carry on their legacy. And these businesses thrive because of people, right? The landscaping business is a commodity. It's not, I don't want to undersell this, but it's not super difficult to have a landscaping business and to have a moderately successful one. But the ones that are exceptional, the ones that we want to buy, have phenomenal owners, and we want them to stay on board. And by doing that, in our last couple acquisitions, we saw it's a talent game. It's not a business acquisition game. It's, can you find the best person? And you, thankfully, introduced me to Adrian probably just over a year ago. And at the time, our thesis was strictly Florida. And we're in the midst of growing that. And after meeting Adrian and talking to Adrian and really developing a friendship that had nothing to do with acquisition, I mean, we would joke about it, but it never went anywhere. And we were more just industry peers, kind of talking shop, really. Hey, what do you guys think of this? Hey, how do you guys handle this? Hey, what's your pricing like on this? Hey, here's our contract. What's your contract look like? And just two dudes that were not from the industry, just kind of learning as we go. Or, hey, did you hear that this happened in the industry? And we really developed, I would say, a good friendship. And it opened up kind of our viewpoint to a different area, because we couldn't go to a different area if we didn't have someone we could trust. And it's hard to have trust in someone that, you meet one day and then 90 days later, you're closing on their business. As much as you think you trust them, you really have no idea about them. And I was able to get to know Adrian on a level that had nothing to do with acquisition. It was straight friendship and just industry kind of peer, and really developed a trust and respect. And I heard some of these stories, obviously, as they were unfolding in real time, and just developed, a huge appreciation for him and what he's going through in his business and how he's kind of fighting through that and the decisions that he was making. And it really developed our thesis as a business overall to not just Orlando and not just, large MSAs in Florida, but to Georgia, strictly because I thought I could trust Adrian and he would be a good steward of the business in Georgia. And so for us, we developed One Outdoor Holdings, which would essentially be the parent company that sits above our different platforms. And we have Benchmark Landscaping, which is our Florida platform. And Adrian's going to spear up the Georgia platform and kind of be the initial business there. And hopefully we're going to find other good businesses around him and do more acquisitions in Georgia under Adrian's leadership.
And Mike, so was One Outdoor, the inception of One Outdoor was because of this acquisition of Adrian, or was it already in the works?
It was already in the works from an ideology standpoint, but we don't want to get too far ahead of our skis. So the realization of it came when we were beginning serious talks with Adrian and thinking it was a real possibility to do a Georgia platform.
Mm-hmm. And again, but just before we get into the story, let's just do that. So you guys were getting to know each other. You were swapping notes with the occasional joke about an acquisition, nobody taking it very seriously. And then take us from when it started to kind of a more serious conversation started to develop.
Yeah, I mean, I think while I say we were making jokes about it, I mean, I was dead serious about it, but I knew he wasn't. I knew he was in the beginning stages of growing his business. And listen, like, I don't want to like pat myself on the back because I think his talent is easily recognizable the minute you start speaking to him. But I saw a guy that was not from the industry, but had a great background, was a good decision maker, was able to fight through the trenches in an industry that's like really, really hard to be in. Like landscapers and blue collar guys, you know, you have to, more so than the normal guy, have to really earn their trust and respect. And Adrian, I thought, was going through some things and handling it great. And I thought the outcomes were great and showing that. And he was growing his business. It wasn't like our conversations was, hey man, I just lost my biggest customer. Hey man, I lost this contract. It was always positive things. It was just the kind of the dirt to get to the outcome. And Adrian, when did we really, really initially start? You actually turned me down the first time when we had a serious conversation. When was that?
I think end of last summer. It was kind of one of the initial talks, and then it kind of, I would say it kind of died down for a little bit. And then I think kind of October-ish time, things kind of reignited. But you guys were in the process of closing your most recent acquisition. And so I would say it was kind of a slower process in the beginning as they were working through their own things. And then kind of after the first of the year, things became a little bit more heated, as it relates to the process.
Yeah, that's right. Yeah, so we made our initial offer to him last summer, like a serious offer, not just, hey, we would love to partner up with you. And, first offer's never good enough, I guess. And Adrian said no. And, I do not fault that because he, was in a good spot and growing. And he's in a better spot now. And I'll let Adrian speak to his viewpoint. But I think some of the things we can bring to him today are hopefully just going to pour gasoline on it and continue to elevate it.
And so, Adrian, did you actually finally entertain doing this because Mike raised his offer, or because these capital burdens just became, you were just like, this is the way out of this is by partnering with somebody like Mike who has more capital to work with?
Yeah, I mean, it's a kind of a combination of both, right? Like, it's a difficult place for him to be in and for me to be in, because I think, when obviously like he has a fiduciary duty to the, his shareholders and the, everyone that works with him to not just pick a business just because he likes the guy and be like, we're going to pay $100 million for that. Right. But on the flip side, from my position, like, I saw all the positive things that had occurred, were occurring. I also saw, the outlook was, which, some recent customer wins, which weren't in any of the numbers. And so trying to weigh, what is a number that effectively captures what has occurred, what, is what I think will occur. Also, so basically kind of provides enough value up, to me, while also isn't asking, for the moon from him, and weighing that with then some of these kind of qualitative things like, what we were talking about with the financing, financing stress and challenges and whatnot. And so I think all of those things kind of added together, is what I was kind of weighing. And I think when we initially had the discussion, it was just tipped not enough in the favor of kind of proceeding. And then, things continue to be good, but we continue to have these challenges. And I think, I don't remember exactly, but my guess is sometime between that summer and fall, when I kind of went back to him, we probably had more of these, same like issues, getting crews started and equipment and everything. And, I think that probably kind of motivated me more to, reignite the discussions at that point.
Adrian, you said something which is, I really want to hear a little bit about, because on this podcast, we just talked to buyers, and now that you're a seller. You recognize that there was a trajectory to your business, that there was going to be future growth. And in your own mind, you wanted the valuation that you were going to receive from Mike to acknowledge that in some way. And yet as buyers, we're always told like, no, we don't pay the seller for the future stuff because that's what we're going to do. you don't get rewarded for that, seller. You only get rewarded
Adrian,
for
did you
what.
ever hear that?
Yeah,
What's
I mean,
happened
we
to
definitely.
date?
Yeah,
So
we
how
definitely
did you
had
think
those
about that as a
discussions.
seller? Yeah. How do you think
Yeah,
about
I mean,
that as
we
a seller?
had like those verbatim discussions, and I mean, he said pretty much that verbatim, and I said something to the effect of like, listen, like, I totally get, like, for this to work, you're probably going to have to feel like you guys are stretching a little, because there's no other way that I'm going to feel like enough value is being captured based off of the kind of prospects and opportunity, and I think we were able to kind of come to an agreement there. But yeah, no, I mean, I think it's definitely difficult for sure. And I had some of these other motivating factors, which we discussed, right, which helped, I think, kind of influence me. Yeah, I think that that is definitely a hard, realization moment, I think, for any seller, essentially. Especially if you're really looking like, oh, hey, I have no problem owning this for 10 more years. Well, then it's going to be difficult to, maybe come up with a number today that you feel like captures enough value for you. I was always more interested in the shorter timeline. And then, like I said, was further influenced by some of these other things. And so I think that allowed me to be a little bit more realistic in that request. And fortunately, I think some of what was going on was pretty tangible. We had won some pretty, sizable contracts, which we had in hand and we could point to. And so I think it enabled us to capture some of the value from Mike and his team, without just, asking for kind of a blank check, like, hey, we believe we can do all this stuff. This, at least we had something more, specific we could point to.
Mike, anything to add to that, or does that cover it?
No, I mean, no, it covers it. I think the hard part is when you develop the relationship for a year and the talent, the skill, it's like price doesn't matter, because like we want Adrian on the team and we know what he can do, but price does matter because we have a fiduciary responsibility. And, overpaying for things gets you caught sometimes and gets you caught holding it back. And we didn't want to be in that scenario either. And I think we were both in a place, and although Adrian so far has shared struggles that he's went through, like he also had massive wins and massive positivity. Is it, Adrian, am I okay to say you doubled or more than doubled your business since you've owned it? Is that okay to say?
Yeah,
I said it, so I guess you could block it out if you want. But are you kidding me? Like, he's owned the business for how long, Adrian?
Like 18 months.
And the dude's doubled his bit. Like, are you kidding? Like, it's insane. And so for us, it was, listen, and my core philosophy is a good deal is when you can put all the deal points up on a whiteboard and have the two principals sit there and say, you know what, I would take your side if I was you. And that person say, yeah, I would take your side as well if I was you. And that's a good deal. And I think if you, had a couple of drinks with me, I would say, yeah, we probably stretched a little, but I think in a year or 2 or 3 or 4 years, it'll be immaterial. And I think if you had a few beers in Adrian, he'd be like, yeah, I think I got a little more, than X, but I should have got more. And I think it's a fair comment. And I think we're both overall happy. We both achieved what we wanted to achieve. And I think moving forward, Adrian's rolling significant stake and is going to be a significant shareholder of the business moving forward still. So, as we continue to do well, Adrian's going to also reap in those benefits.
I want to get into the terms a little bit. I'm sure we'll have to be vague, but people are going to be interested. But just last thing before we do, Mike, you've said a lot about how, you really think about your acquisitions in terms of the talent, and respect for what Adrian's done. Also that you're acquisitive anyway, and that you're kind of, your thesis has expanded geographically. And so here was an opportunity to move into an entirely new state, Georgia. But was there anything about Adrian's business that you liked in terms of like the mix, commercial versus residential, maintenance versus project, all of that stuff? Are you agnostic on that?
Great question. I think Adrian has if he didn't have this, we wouldn't have been able to partner up, but he has the exact same viewpoint that we have on business mix and of service mix and the quality of revenue. And I got to learn about the construction side of his business from him and the pros and cons of that, as well as we were acquiring businesses, we were acquiring a little more construction and a little more construction. But I think our goals are aligned in that in this area that we're playing in, commercial maintenance is the focal point. Everything else is not ancillary, not immaterial, but it needs to be material to growing the core of commercial maintenance. So it doesn't matter if, you have 80% construction or 20% construction. That construction, the cash generated either needs to be used to grow commercial maintenance, or those opportunities need to result into commercial maintenance at the end of those projects for those properties. And I would say we're pretty aligned on that. And it made it attractive that we were aligned on it.
Great, guys. Let's get into the terms to the extent that we can. How is the deal structured, just broadly?
Yeah, you want me to take that?
Sure. Yeah, Adrian, go for it.
Yeah. So as he mentioned, it is the deal assumes that I am rolling a sizable amount of money into the the new entity, which interestingly, and I'm sure this doesn't always happen, is that was something that was probably equally as important to them as it was to me. From their perspective, obviously it kind of ensures alignment of interests and motivation and all of that stuff. And I think for me, from my perspective, like I saw all the positive stuff that we were doing, and as we were just talking about, like it's difficult to capture all that value today when you believe in a 2-year or 3-year trajectory of a business. And so for me, it felt like, okay, well, if I can find an opportunity where I can roll a significant amount of money, well, that'll allow me to get, kind of that second bite at the apple, which will allow me to, capture further value, when that's obviously realized. And so that was, kind of a day one requirement by them. And it was great because, that was something that was important to me and I wanted anyway. So anyway, to answer your question, it's kind of a mix of cash and then me rolling a portion of it. And
when you say a significant portion, I assume you can't say exactly what that is, but give us a range. So like is first of all, for people who, first time listening about stuff like this, rolling means that you are taking some of the equity. So if Adrian's business, let's use some numbers from here on out, just for simple math, say it's $1 million. The valuation of Adrian's business is $1 million. I have no inside information. I'm sure it was not that number, but for easy math, $1 million, and say Adrian takes part cash, part equity in Mike's business. Rolling is the equity part. It's basically he's rolling, let's say we're 50%. Don't think it was, but say we're 50%. So $500,000 in cash goes to Adrian. Then he takes $500,000 worth of stock in Mike's business. That's rolling his equity with the idea, expectation, and hope that $500,000 worth of stock in Mike's business will, at some point in the future, after Mike and Adrian have grown together, be worth more than that when Mike goes to exit the business to a yet larger player. And by the way, that moment is called the second bite of the apple. So Adrian then gets a second liquidity event for his business. So rolling equity is that putting that 50% into Mike's business. What is, again, probably can't be specific, but when you say a significant piece, Adrian, give people just like a ballpark. Is a significant piece like 99%, like you got 1%, or is it 10%? Like give us a ballpark here.
Let's say
I think the easiest way to say it is we are the majority shareholder, and so that obviously would be 51% or greater. But our requirement for owners is they need to roll a significant stake where it is very meaningful to them, and it's meaningful to us. And our goal and hope for them is the second bite of the apple is worth more than the first bite, even if it at a much lesser equity ownership of the business. So today, Adrian owns 100% of Georgia Skates. He's getting paid for X percent of that. The remaining percent that he's rolling, we hope is more valuable at the second bite, whether that's us transacting and being acquired, or that is us doing share buybacks or share purchases at valuations throughout our tenure together to provide liquidity for owners that have equity.
Yeah. I was just going to, the one thing I would just add also, Will, to your example, right, where you talk about the ownership percentage under the new kind of structure or new entity. I think the important thing to note on that, right, is that, and one of the reasons for Mike saying what he's saying is that, it is an ownership percentage in the new entity that is now has the financial backing of the broader platform, right? And so when Mike earlier was talking about, the kind of the analogy of pouring fuel on the fire, right, and utilizing their resources. So I think what's appealing to me is having this significant stake and ownership percentage in this new entity, but under a structure where we're going to now be much more financially supported. So I think that's how you ultimately see, or one of the reasons or we will see that, ownership percentage and value of equity being worth, hopefully many multiples of what it, in the future, because we're now going to have the proper kind of financial support in place.
And also there's an expectation, because Mike's larger business is so much larger, it'll sell for a larger multiple. I mean, if it sold today, it would sell for a larger multiple, Adrian, than you could command for your business. But in another 3 or 5 years, presumably a significantly higher multiple. So you're getting probably better multiple expansion on the equity that you rolled than if you had stayed independent. Is that a fair conclusion, or am I stretching it?
That's definitely the hope.
We sure hope so.
That's the obvious. Yeah, right. Okay.
Well, it's with anything, right? Like if let's say you're a larger strategic in the industry, or you're a private equity firm or family office, or, a guy looking to buy into the industry, would you rather have a single business in Orlando or a single business in Atlanta? Or would you rather have a business that has market share of Orlando, market share of Atlanta, market share of to be determined MSAs and coming up MSAs that all have processes, all have systems, all are on the best ERP in the industry, and have been able to have management tiers and kind of all those things that you would expect? You would hope you get multiple expansion by doing that. And as a buyer, at that level, that's what you expect and that's what you want. So the sum is greater than the parts in a lot of ways. And that is kind of our goal, is putting these businesses together and putting great people together. And I think something that I don't want to also lose track of, because I talked a lot about me and what I thought of Adrian. I think without it being intentional, I think Adrian has had a front row seat to see us and how we react and how we pour gasoline on businesses with the decisions we've made as well. So I think he's had a front row seat and has probably made him more of a believer in what the future is going to hold by seeing what we've done to the businesses we acquire.
Yeah.
Yeah. I mean, I would definitely agree with that. And the only other thing I would just say too, in that, kind of along the same lines, is that, they've been doing this longer than me, right? And then the team that they have in place has been doing it substantially longer than me, because they have people, he has people running some of these businesses that have been in this industry forever. Because of all that, right? Like when Mike and I have had discussions even a year ago, but certainly more recently, I definitely have come to appreciate, and I think one of the things that helped kind of drive this and encourage me to do this was that, like, there is a lot that we can learn from them as an organization because of the experience that they have. And so, obviously the financial stuff and all of that's great, and the support that they'll be able to provide. But I think there's quite a bit of just operational insight that is, pretty important to me also, right? Like, I think, we probably could have found a financial partner that would be willing to have supported us. But that doesn't necessarily provide the same level of operational benefits. And I think there's been a number of instances where maybe, we were curious about how, the best way going about doing something or whatnot. And, I would go to him with some of these kind of ideas or issues that we're working through. And they, we would talk through them, and he would kind of explain how it's being done on their team. He would, sometimes kind of connect with their team and get other people's opinions. And, that stuff has been certainly, helpful for my end. So, I mean, I think that component is really important to kind of mention as well.
Well, peer groups seem to be in the air on Twitter. There's new startups around it. There's just a lot of talk about it, the need for it, the value of them. And you kind of have this now with each other in the larger One Outdoor family, kind of this peer group effectively of, what's working in Florida, what's working in Georgia, really swapping notes, leaning on each other, learning from each other faster than you would otherwise. But I do just want to go back to the math, or just really quick on the multiple expansion piece to make sure I understand it. Yes, we hope that the money that you rolled, Adrian, the piece that you rolled will be worth more in the future, and expect that as One Outdoor grows. But I guess what I'm trying to understand about multiple expansion is let's say Mike doesn't grow, like an additional $1 of EBITDA that Georgia Escapes earns tomorrow is already more valuable than Mike buying you before, because it's part of a larger entity that already, without even further growth, already commands a higher multiple. So the EBITDA you're generating instantaneously becomes a little bit more valuable. Is that right?
Yeah, exactly right. You said it exactly right. So I don't really have much to add other than it makes everyone more valuable. The bigger we get, the better we get, the better quality we have, and the better people we have.
And just before we move off from the deal altogether, were there any other high level deal points that people could learn from? I assume Adrian's compensation is one. Kind of the working capital. I mean, obviously, I assumed you negotiated something where there's going to be a lot more working capital. The whole, one of the big reasons for this, where free cash flow. I mean, any other things that you would educate the audience on a deal like this? Like, what are the big points of negotiation?
I think from our viewpoint, and in terms of compensation, we treat the CEOs of our platforms as the CEOs of our platform. So that means they're compensated like a true CEO. They have autonomy like a true CEO. The decisions lie with them. We are here to make sure that, just go back just a little bit about what I said, our ERPs are the same, our accounting is set up the same. All those things for process oriented are the same across the board. But other than that, it's full go how they want to see the business. That is completely separate from ownership in the business. So we treat Adrian as the CEO of Georgia Escapes, our Georgia platform, and he has full decision making of that. And additionally, he's also owner of the business. So, he should have aligned interests as well with us when making those kind of decisions. So in terms of comp, I don't know if that's what you're looking for, but that's how we think of the leaders of our organization. And the only other deal points I think is interesting is we did this as a stock transaction and not an asset transaction, which is new to us. We've always done asset deals. This was a stock transaction, so it kind of muddied up the ending a little bit and some artificial delays. But that was the only thing different from our viewpoint, was that.
Mike, we're starting to wrap up here, guys. But Mike, I just want to. People will have heard part of your story on this podcast, others, but just give us 2 or 3 minutes, because it's just striking how you went from an acquisition entrepreneur who bought a too small landscaping business by your own description, and are now this very acquisitive and kind of large player in the world of landscaping. Was that shift gradual, or was there a moment where you perceived opportunity and just really went after it hard?
Yeah, I think that all depends on your perspective in terms of the gradual part. I bought the first business December 11th of 2020. So, it hasn't been that long in the grand scheme of things. Look at the owners we're buying from that hold businesses for 20, 30 years, right? Once we got it going, we've been on pace for an acquisition per quarter. So literally in the last 6 quarters, 5 quarters, we bought a business each quarter. The shift really came about. I had no idea about the industry. I act like I knew about the landscape industry. I I couldn't tell you how to turn on a damn lawnmower. I didn't know anything about it. I thought the landscaping industry was John in his truck outside, and I'm like, well, I can run a business better than that guy. Like, the dude doesn't even bill me for my lawn. So, all I got to bill people, I'm already better than this guy as a business owner. And like, I had no idea about the industry, the size, the makeup, the differences between commercial and residential, other than the obvious. And so I really I feel like I got a degree in landscaping, and then I'm trying to get a master's degree in landscaping by being around industry people. And it solely out of opportunity and being aggressive and being able to capture that opportunity is what's led us to grow. And I think we've created a flywheel, and I say this all the time. Our momentum now is strictly a flywheel on the people we acquire. So, and go back to what I said earlier, that we're only acquiring businesses where the owners are going to stay on, or management team's significantly valuable in the business. What that does is, when we buy a business that is in good standing and good brand, I'll say, in the community, as well as with a good owner in the industry, what's the first thing that happens when it's known that he's been acquired? All his buddies in the industry ask him about it, or he tells his buddies, his wife posts on Facebook or whatever it is, and everyone asks, oh, what happened? Who bought you? How did that go? And if we're buying good businesses and good owners, and then they can introduce us to the next guy or talk to us about the next opportunity, and we buy that business, and then we get opened up to another opportunity. So we're continuously trying to create the hub and spoke method of acquisitions. And we are going to be extremely disciplined and extremely considerate and thoughtful on the acquisitions we're doing, because it's more about the people than the business. If Adrian was not a part of Georgia Scapes and it was just some random guy running it, we would not be buying Georgia Scapes. That is not a knock on Georgia Scapes. It is because of our belief in Adrian. So that is what's crucial to us. And we feel like we've created the flywheel, the flywheel's gotten going, and you never know who's going to introduce you to the next acquisition. I.e., you introduced me to Adrian, and a year and a half later, here we are. So we feel like we kind of got that turning, and that's what we look for. But yes, December 11th of 2020, and here we are today, and we have a few more kind of queued up and ready to go to expand this even further. And it's all just been kind of learning as we go and finding opportunity.
But there must have been kind of maybe the second acquisition where you were like, I guess I could do a second acquisition too. And then you do it, and then it goes well, and then you're like, okay, well, if I can do two and I can figure out how to integrate them or at least keep them together, then I can do 200. I mean, because you didn't, as you said yourself, you didn't set out to do what you're now doing. And my point was, it has been a short amount of time, 3 years. So I'm just.
Yeah, the first two acquisitions sucked.
Especially Mike, because so many people who do roll-ups set out to do them. They have this master plan, this grand plan that they go into it with. Whereas yours seems like it happened kind of as, you were building the plane as it was crashing or flying or whatever.
Yeah, I would say the idea was there. Like, it was always in the back of my head to acquire more. How we've done it and the path we've went and the scale we've done it is materially different than what I thought. I thought we were just going to keep buying little, small $1 million a year revenue, but not SDE, not EBITDA revenue businesses, and kind of just packing that on in a tight geographical area. And we've obviously went away from that and changed that whole model. But I mean, the first two acquisitions we did, the acquisition and the first 30 to 90 days sucked. I mean, it's the worst moments of my life ever. And, but we were able to kind of get through it and learn from it and change it on the following acquisitions, where it's like, okay, we feel like we kind of got a playbook here. We feel like we know what to do. We feel like we know what to expect. We feel like we know what's around the corner, to the point where, and I'm assuming Adrian's probably the same, but like, I can look at a landscaping deal and get 2 or 3 questions answered and know if we should buy it or not. It becomes what price. It obviously outside of the people, but yeah, I mean, we've gotten better. I had no idea what the fuck I was doing in the beginning, and now I feel like we at least know what direction we go.
Guys, I want to close out with a question about SBA loans. So we've already touched on it somewhat, Adrian, obviously with your loan and how hard it was to get credit afterwards. Was there anything more to say on that? And I can also just tee it up this way. Is there kind of like something you would want SBA searchers out there to know, other than what you've already said? Be super careful about the credit piece. Maybe, or if you had to do it all over again, would you not use an SBA loan and try to use other sources of capital? Anything you want to close out on about the SBA, Adrian?
Yeah, I mean, I know Mike has very strong feelings on this, but I think generally, like, I think the SBA is an incredibly important resource, right? I don't think that there's a lot of other ways that individuals can buy companies for 10% per, equity. So, I mean, in that sense, like, I think it's an amazing tool. I think what I did not appreciate enough going into it is that it both enables these acquisitions and then really hamstrings your growth ability, post-close. And so unless you want to, take on further SBA loans for acquisitions, or, I've heard of people in certain instances being able to expand their note for certain purposes. Like, unless you have that appetite to kind of continue down that rabbit hole, once you're in the SBA kind of term period, there are limitations to your growth. And so if you have a minimally capital intensive kind of GDP plus growth type business, and you're going to buy with an SBA loan and you feel pretty comfortable about, a variety of those, key criteria, like, great. And I think it's an awesome tool for that. But I think if you have aspirations of high growth, or if you think your business is going to require, new equipment or whatever, like, I think people just need to understand a little bit more of kind of what they're getting into, and what it may be like kind of navigating, their business basically under that framework. And again, like I said, like, I think most searchers, don't underwrite 50% annual growth. And therefore, the model looks fine. And, we did experience that and have been experiencing that. And you couple that again with the equipment and, adding people and all of this stuff. And so I think it's just, being a little bit more eyes wide open to, where there may be limitations, and then trying to understand, like, do I think my scenario will be one of those ones that kind of check the box of, hey, this could be a problem or could be difficult utilizing SBA. That being said, again, back to my initial point, like, not a lot of other options out there for people. You buy, even, to your earlier example, like, just $1 million business, like, not, without the SBA, a lot of people aren't going to even be able to buy that. So I think it's an awesome tool. I just think people need to be a little bit more understanding of its challenges.
I think
Mike, you have thoughts? You have thoughts on the SBA?
Oh my gosh, you have another hour? I think what Adrian's saying, like, is so, like, everyone's like, oh, the SBA, this business won't go down, right? Like, that's how everyone models, like, using debt is like the floor essentially of their deal in the model. But Adrian experienced, like, crazy growth. Like, think about this. He did everything you want as a business owner, right? Like, he hired well. He, took on new customers. Like, he did good sales, and still struggling with it. So, like, that's just the part of, like, the SBA that I always tell people, like, think about the good and the bad. Like, the good is you grow by 50%. How do you handle that? The bad is you go down by 50%. How do you handle that? So Adrian's like, almost should be a hero success story of the SBA. Like, the dude used an SBA and doubled his business. Like, are you fucking kidding me? But, like, there comes challenges with that. And I just wish more people were open-minded to the pros and cons of it. But I do think it's a great tool.
Gentlemen, this was fascinating. Congratulations both on your respective businesses and now the combined entity. It'll be really exciting to see what happens in the years ahead. I'll let people know how to reach you. You've both shared your contact information many times on the pod. So we'll just close it out here. And thank you both for coming back on and giving this exclusive to Acquiring Minds.
Will, man, I appreciate you. And
thanks for the introduction to Mike a year ago.
Yeah, absolutely.
Absolutely. Thanks, Will.
Good deal, guys. Thank you. I hope you enjoyed that interview. Make sure you subscribe to the Acquiring Minds channel below. We are now publishing twice a week, so tons of new interviews and stories to come. Stories that will help you along your own path to acquiring a business.